Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Often on this program, we try to speak to the people that manage your money so that you get a sense of how they see things, how they see, one, economic growth, how they see earnings in the corporate landscape and the companies that they invest in, and what their expectation is going forward. And joining me today is Harish Krishnan, who's a co-CIO and head equity at Aditya Birla Sun Life AMC. He manages quite a few of their schemes, including, not least of which, the Flexi Cap Fund, which quite a few of you will be familiar with. Harish, thanks so much for taking the time. Pleasure speaking with you. Let me start by asking you to set the context for us. How are you seeing things amidst all of this swirling uncertainty on tariffs and everything apart from that? How do you as a fund manager deal with all of this disparate information?
Right. Nice to be on your show, Alex. So clearly, we at Aditya Birla Sun Life focus more on the medium term rather than necessarily focusing on the news for the day. And while today now seems to be a moment where there is a plethora of news, be it in terms of tariffs, be it in terms of GST cuts, etc., ultimately markets are slaves of earnings. And what we want to kind of get a sense of is where earnings are headed, say over the medium-term perspective. Now, let me give you some thoughts as to how we think about earnings of corporate India in aggregate are likely to shape up. Over the course of the last 25 odd years, when we look at corporate earnings of India Inc., which is listed, we generally see them doubling anywhere between about 5 to 6 years. Now, this is the averages. Now, as many of you may be aware on your show, averages can be misleading because there are both a very short span of time where earnings can double, like in the case of during COVID, wherein we saw that earnings doubled in about 2.5 years, where a huge amount of things came together to make that happen. And there are also time frames like what we saw in 2010 to 2019, wherein earnings took about 8-9 years to double. So this 5 to 6 years is the average of all of those doubling times. Now, like I said, what we saw immediately after COVID was a combination of multiple things to kind of come together so that earnings doubled in about 2.5 years, which is unlikely to repeat. But we do think that, over the course of the next 5 to 6 years, earnings of corporate India are likely to double, which is primarily predicated on the fact that the raw material for earnings growth is capex. And capex, we have started seeing that starting to emerge through. Again, it's not something like it's a dramatic kind of a shift, etc. But this is how the gears do change. From the neutral gear, they move to the first gear and then to the second gear. And when it starts going really fast in the third and fourth gear is when it starts making the newspaper headlines. At this point of time, we think that capex is more in the first and slightly moving to the second gear. And that gives us confidence that as and when this corporate capex continues, we're likely to see that earnings growth. Of course, there needs to be an enabling environment. And that enabling environment is coming courtesy, very strong balance sheets of corporate India, very strong balance sheets of the banking system, as well as all of these things, be that of the GST cuts, be that RBI has cut interest rates, be that of the tax savings that the government has allowed, as announced in the budget. All of these things together is likely to shape up demand to encourage this further capex build out coming through. So therefore, we think that from a medium-term perspective, we continue to remain positive on Indian equities, continuing on their wealth journey per se.
Okay, but we're speaking in September at a time when earnings has not really been blockbuster, of course, and nobody expected it to be, Harish. But it's a little harder to stomach when you had multiple years of fantastic growth. And so therefore you're spoilt by a kind of a run rate that you got used to. And it's hard, therefore, to come to terms with a year of consolidation, which a lot of people are calling it. When do you think that you can break out of this funk? As you've pointed out, private capex maybe in gear 1, gear 2. When do you anticipate that it can accelerate further?
Sure. No, I think it's a very telling point, especially after 3 consecutive quarters wherein we have had, say, mid-single-digit earnings growth. So our base case is that all of these cuts of GST, tax cuts, as well as the RBI-induced policy rate cuts, all of that should lead to an improvement in demand sequentially going forward. And therefore, by the end of this fiscal, our sense is that we are likely to get into the double-digit territory. Again, it's not going to be something which is the third year or the fourth year kind of a screaming earnings growth rates that many people have got used to amidst 2022 to 24, wherein, like we discussed, we were spoiled for choice. But it would still be a step up from the current, 5-6% growth rates that we've kind of seen over the course of the last 3 or 4 quarters. So that is point number one. Secondly, we think that this double-digit growth rate has got further room to improve as we go on to FY27 to go more closer to that 12 to 13, 14% kind of a run rate. Again, is it going to set the pulse racing with those kind of numbers is what really our job is, which is that there are pockets of growth which can be faster than that number at the headline number, and that is where we would want to kind of invest in, provided valuations offer some amount of margin of safety.
Okay, let's delve a little deeper in your own portfolio construction, and here I'm specifically talking about the FlexiCap fund. And I know that you're also looking very closely at the other schemes, but then because it's a blank canvas kind of a scheme, it should give me a sense of how you're looking at your investment philosophy as well. I was looking at the last disclosure, and I see that you have a pretty substantial allocation towards the large banks and financials, right? What is the thinking there? Do you anticipate that that is going to be one leg of growth that will kick in? Ultimately, corporates have not been borrowing for capex. So when that shift happens, do you see corporate lending take in charge, or do you anticipate that the consumption boom that everybody is predicting because of the multiple levers that have been utilized will come through and retail lending will take charge?
Sure. So I think, see, as far as large banks is concerned, our thesis is as follows: that the size of India's GDP, which is anywhere between $4 and beyond $1 trillion, which is likely to double over the course of the near foreseeable, say 7 to 10 years, we should be having a lot more of lending activity and financial activity for sure. Now, as we speak today, we the regulatory dispensation over the course of the last few years has made backing extremely regulated, which means that say about 5 or 7 years back, there were many promoters and entrepreneurs who wanted a banking license. Today, it appears that nobody really is clamoring for a banking license, and it's the same set of companies which are there. Secondly, access to capital. If you were to look at it, barring the top 4 or 5 private sector banks, almost all other banks are, just about at book value or trading below book value. Which means that access to capital, which is a key raw material, is available in plenty for the larger franchises and not necessarily for bottom of the round, which presumably means that the potential to take away market share is far higher in that kind of a growing economy. So that really is a bedrock of why we think that the larger banks are likely to benefit. Yes, there is the here and now as well, which is that we are going through a slowish or a sluggish credit growth. We are also starting to see an inch up in asset quality, and we are also likely to see net interest margins come off, as RBI continues with its rate cut, presumably under such rate cut going ahead. But those are the here and now, which are definitely headwinds for the overall banking system. But just like when banks were making a lot of money in 22 and 23, when credit growth was very strong, when asset quality was supremely good, and when NIMs were at record highs, and their stocks didn't necessarily participate in that euphoria, we think now that the downgrade or the poor earnings, run rate that can come through is something that the market is willing to possibly look over, especially over the course of the next 6-12 months. Because as you rightly said, all of these rate cuts, these consumption boost will all likely improve the overall lending profile and the longer term growth runway for the banking system. So that really is our thesis of the overall banking space.
Okay, so that's banking. But then the other leg that a lot of people are betting on, as I pointed out, or in the previous question itself, I was referring to it, Harish, was consumption, right? And we've seen quite a lot of activity in anticipation of the GST announcement. It came through in rapid fire time. What do you think about when that will start playing out on the ground, though? 22nd is when the applicability comes through. But on the ground, when do you see that movement?
Sure. Clearly, consumption habits are very difficult to call out. Exactly what is it that is going to catalyze all of it is only a hypothesis at best. And there has been a lot of focus from the government to get this going. So if we take a step back, from 2018 till 2023, the focal point of the government was primarily supply side reforms, which was giving PLI incentives, which was giving corporate tax breaks, etc., or focusing on logistics, overall infra creation, etc. I think in 2025, the budget that came through and then followed by the RBI cuts and now the GST cuts in very quick succession, there's been a pivot as far as the government focal point is concerned, which is to get the demand side equation right. And therefore, I think with such a big shift that has happened, it is, to my mind, quite inevitable that consumption starts coming back. Again, it is not to say that, there aren't pockets of consumption even today. Look at quick commerce, look at apparel, fast apparel. There are enough avenues to suggest that consumption is not completely over and out. But yes, on an aggregate, those are far and few. I think the idea is to mainstream consumption across categories, which is where this tax cut of GST can be a very big positive. And therefore, I would expect that starting in this festive season and possibly beyond, we should start seeing this engine starting to rev up again. Going back to the gear analogy, it is getting back into the first and second gear. All the newspaper headlines will start screaming only in the third and the fourth gear. So that's still some time away.
But then from the perspective of the investor, you should be getting in at gear 1 and gear 2 so that you can enjoy the pace that you will see later. But that brings us to the conclusion of this conversation, Harish, which is that I started with a question on the fact that it's hard to stomach a year of consolidation, but it also helps to get perspective and to set those expectations, right? So from your perspective as a message to your unit holders, what would you say should be the expectation in FY26 and beyond in equities, in not the necessarily 5 to 10 year horizon, because let's face it, people look more near term, but FY26 and heading into FY27?
I think that, after a very strong run up that we've seen in 22 to 24, one should be waiting out for consolidated returns. I think positive returns in 26 and 27 is what I could think of would be my base case. Now, will it be something that is going to be substantially higher? Possibly not. But can we be getting at that early double digits or low single digit kind of returns for the next 12, 18 months? I think it is quite possible. Beyond which is when I would think that a lot of whatever we spoke about, the fact that the demand side stimulus will come into place in full being. You also have the private capex in tandem because of that improving capacity utilization start coming through. And that is where that virtuous cycle or the flywheel comes through, wherein supply also gets created, and therefore that brings in that overall vibrancy in the overall market. So I would say that one should be prepared to grind it out over the course of the next 6, 12, 18 months, which is not a bad outcome if you have a long-term horizon, that is.
All right, and that allows you to accumulate a lot more units than you otherwise would be able to. Thanks so much, Harish, for taking the time. Pleasure speaking with you.